Morning, everybody. It's Friday the 14th, not Friday the 13th. We got that wrong on our email invitation for today's webinar when we sent that out yesterday. That's my fault. But I think you guys all got the gist of it because I see we have good attendance this morning. Some people still piling in. Maybe I'll hem and haw a little bit here while we let some more people in. Yeah, we're coming in pretty good here. I'm going to go ahead and just move along. Anyways, what's really going on here? We had a buy signal in the market direction model, I think 3 days ago or 4 days ago, and that went back to neutral pretty quickly. So minimal damage on that. But again, the market direction model acts, and I noticed this mostly on buy signal. It seems to act more like an oscillator than a directional pointer per se. I think the signals seem to be better on the downside because the last sell signal we had was a good move. It made about 10% on the downside. The only problem is it didn't go back to a neutral until that was pretty much given back. So you're still, I think, in a market that is essentially being driven by quantitative easing. And if you stop and think about it for a second, I think this is right. And Chris, you can correct me if I'm wrong here, but I think have we been at 25%, 0.25% interest rates for what, 4 years now? Is that right?
I believe, yeah, since 2009, everything got ratcheted all the way down,
Right,
and
and we've
we
pretty
went to
much
rock
been there.
bottom for a long time now.
Yeah, and so we've been there for what, 3, 4 years, and what's happened with the economy? Well, pretty much nothing, and the Fed's still talking about, still talking about lousy employment going into 2015, but now they're talking about pegging interest rate policy to, I think, GDP and the unemployment rate or employment growth, which I think is fascinating, and it tells you that there's really no traction being obtained through the use of this QE, at least not for the economy. It goes piling into the risk-on trade, I think, because they have nothing else to do with the money. The banks aren't lending it out; they're just hoarding it. And so, I think what this does is it just creates a wildly distorted market. And I don't think that any back test of the way the market's acted historically is going to work out here because you're in this totally bizarre, uncharted territory that I think is troublesome. And it's not just troublesome, for the long side. Also, it makes things a little funky on the short side, but that's pretty much where I've been making my money lately, and I've been staying on the short side mostly and shorting into the rallies when they stick their ugly little heads up again. And basically, you can see on the NASDAQ chart, you guys are going to have to look at my main screen here because I am pretty heavy. I'm about 250% short the market this morning. We've had Priceline, Google, and Apple have been my main targets. Some secondary targets in Alexion. I like this NSM. We'll talk about that in a little bit. It looks like a head and shoulders type formation, but I'll get to that in just a little bit. You see, though, the NASDAQ here looking good on a breakout. You got this sort of cup with handle. Some people even see a reverse head and shoulders. I personally see a flying eagle. This is the feet down here, and here's the body of the eagle and the two wings. You see, so that's a flying eagle formation too, and so I don't know if I guess that's a bearish formation, unless, well, if the eagle is landing, I think then that's a bearish formation, so maybe that's what that means. But, whatever you want to make out of this, it started to look pretty good 4 days ago, and it did. It looked like we were getting a little bit of traction. Maybe the leadership was picking up a little bit more. We saw some more breakouts in stocks earlier this week, but all of that has fizzled out pretty quickly. And I think that's symptomatic of what this market is, essentially a QE rally. But I also think investors have been really because they think there's going to be a solution to the fiscal cliff before year end, and therefore there will be a rally. So you have to wonder, whether this is what the crowd knows and whether or not this is becoming a little bit too obvious. Hence, it's a sell the news phenomenon. Dr. K, I hear you having a shootout over there again with some of your alerts going off. What I'm looking at here is market breaking down, NASDAQ gapping down below the 200-day after closing back below the 50-day. So I kind of think you're running into some trouble with this rally, and it's in a very failure-prone position. This is why I've stayed on the short side. So, NASDAQ's looking weak. Obviously, any breakdown from here, and what you're talking about is testing this low down here, which is somewhere above the 2,800 level. And ultimately, maybe you get down to the lows of last June on a new let down leg. But we'll see how that all pans out. Let me make this a little bigger so I can see what I'm looking at. Whoop. E-signals decided to go on the fritz here. Windows-based programs, I hate them all. So here's the June low here. You could be headed possibly for that, and I would expect if we did start a new down leg, that's what you would be seeing. But all of this is still in flux, and of course you have the potential for a rally from some sort of fiscal cliff agreement, which I would look at as a short sale rally, or a rally to short into, and because I think it would be something more akin to a sell the news phenomenon. I could be wrong, but that would be my tendency, given the fact that you're not really seeing any leadership act very well here. So we can get rid of that. We're looking at the not the utility index, but we'll look at the S&P 500. S&P 500 is coming down to its 50-day, so it'll be critical today, I think, whether we see it break the 50-day or not. If that would confirm the weakness in the Nasdaq and the potential for another downtrend. So kind of watch for that today. It's still early in the day. We're only an hour and a half into the trading day or so, so you're still very early in anything. And as we know, in this market, anything has happened, so anything can happen. So keep that in mind. Looking at what I'm doing today, 250% short. I'm ready to go 400. All I need is to see some signals here. I think the rally in Baidu is interesting. It looks pretty ugly here, but you get this drift up, and these things sometimes can drift up a lot further than you think, and this thing has come all the way back up into a position where it almost looks like a little cup with handle here, if you can see this on the daily chart. And it could rally further to 102.68. What I'm watching for today, of course, we're using this chart, this 620 chart, is watching for a breakdown and a sell signal. You almost got it here briefly, but it didn't happen, and so here we are around 97, pushing up on the daily chart, and you're just kind of keeping an eye on this one. Price line has just hit a sell signal, so this is, if you came in overnight, or if I came in overnight with a position in price line short, now I want to come after it more aggressively. Google yesterday, we talked about this one earlier in the day. It was pre-open trading around 7:15. I actually decided to be bold and brave and stupid, but I still got away with it, shorting it up around 7:11 up to 7:14 or so, and then we got the sell signal. It never really looked back till the end of the day, and then you just fluttered about the 20-period moving average. But you did get the sell signal, so that could have been an entry. So you could be holding a position short and watching this morning for another breakdown. That would be a sell signal here, and of course we see it suddenly starting to break on the 5-minute chart here. So that's that would be a situation where I would want to go hog wild on the short side with the stock. But again, remember, use this to keep yourself out of trouble in terms of stopping yourself out. So even yesterday, if you had shorted this and you wanted to day trade this thing, you could have come back in and just covered somewhere around 702, and you would have not been too far off from where it closed. So you get what you can out of this market at times, maybe holding core positions short that have continued to work. And of course, the one that has really continued to work is Apple. And Apple's just an incredible dog at this point. We got a big gap down today. Chris, what's the volume looking like this morning? That thing's up 188%, and it actually has been picking up as the day has been wearing on. You're seeing it's breaking the 510 area. And what you get in this, and I think this is a phenomenon that you will see, and that I've seen actually in stocks, is studying the short side and looking at stocks, big leading stocks as they've broken down. And you can go back to March of 2000 and look at some of the big leaders. I mean, that was a time that people were almost religious about the stock market, and they were religious about .com stocks. And I remember going into a big hedge fund. Chris, you were there in June of 2000, and these guys were long InfoSpace and Qualcomm and AOL and all these big stocks that had been huge leaders in the bubble market, the .com bubble market of 2000, 99, 2000. And these guys were in love with these stocks, and I write about this in our first book, Trade Like an O'Neill Disciple, where they had just hired $1 million internet analyst from Merrill Lynch, and this guy was laughing at us because we were telling him all these stocks had topped. But my point is that you get this sort of fervent, almost religious-like belief in stocks, and so what this does is it drives in buyers who are trying to catch the falling knife. And so in Apple, let me make this a little bigger, you have this straight down move, and when you think about it, given that Apple is such a beloved stock and such a great company, and they got great products, and they're just going to grow earnings forever, and the stock's going to 1,000, and you have to own it not as a trade but as an investment, according to Jim Cramer back at around 650, what he was telling people. I don't hear much about that anymore, but this sort of just fervent, almost religious fervor for the stock. And what it does is it drives these people in, and you see the big volume spikes when it comes down. But you can see what happens. People trying to buy it on the way down, it just adds to the selling pressure as they get underwater. And essentially what happens is you get these trapped longs, and that's what we're talking about over the last couple of weeks as you come down off the 200-day moving average. The 50-day is now crossed below. I know I've got a lot of lines drawn on this chart. They're just there to confuse you. But you have to admit all the colors do look very pretty. Anyways, I think right now you have a lot of trapped longs in the 530 all the way up into 580, 590 area, and so any rallies get squashed, and over the last few days you've seen that happen. I was also interested that a broker friend of mine called me on I believe it was Wednesday morning when the stock was up, bragging to me about how he was buying it for his clients at 522, and of course I hope he certainly sold that out because they're all underwater now. But it's a classic retail schmuck mistake to think that something is cheap, but of course you can get people to buy it. I also hear that a very popular product out there in the retail investment arena are structured notes that are tied to Apple stock. So essentially a brokerage, most brokerages I think are hurting for capital, and they're trying to keep their capital levels up, so they want to go out into the market if they can and borrow more money to raise their the capital on their balance sheets, the cash on hand or whatever, and they do this by borrowing money. So what they do is they issue notes to their clients. Yeah. So let's say, for example, you buy one of these from UBS, which I know is offering a structured note tied to Apple stock, which we can see just moving lower. And they pay you, I don't know, 1%, and they have some kicker in there that it'll go up to 10% or 8% if the stock gets above a certain level. Well, this thing doesn't have a snowball's chance in hell of getting to that level, but they can suck people in because of the religious fervor surrounding Apple stock. Remember that article, Dr. K, we wrote for Forbes when the stock was trading around, it's a lot higher, and man, the venom coming from people was amazing.
People are married to the stock, so they don't want to, they don't want their wife soiled in any way, and they'll continue to wear these blinders. It's interesting, the psychology of people who've made a lot of money in a stock, or at least seen the stock go up tenfold or more, and when the signs are there that the stock is starting to top, they choose to ignore them. And of course we saw that in the year 2000 during the dot-com bubble, bursting of the bubble.
Yeah, and so it's that sort of thing that drives people into the stock, and as more dumb buyers come in at higher prices, they now add to the selling pressure, and that's what creates these downside streaks that blow people's minds. And you'll see that, you can see some of the breaks off the peak in March of 2000 of 40-50% off the peak, and Apple right now is a mere 27%, so another 10% to the downside from here would not be something that I think is unexpected. And I think most of the crowd seems to think that you've got to own Apple. Anyways, those are the three things I'm looking at. We're looking at price line breaking, but nothing yet. You can see the stock gap down on Monday, and that was actually a shortable move if you're watching it. I've been keeping an eye on it, saying it looked pretty good coming up this way, but no real pocket pivots anywhere in here, so you didn't have any really constructive action in terms of viable points in the stock, but it was moving higher. I don't know, maybe this was a pocket pivot. In any case, the stock is broken down below the 200-day and the 50-day. So any little bump towards the 50-day at 620, so it got up, I think, 616 this morning, I think it was. What was the high today? 617.93. I think that becomes shortable on the basis of it rallying up to the moving average, and then you go hog wild. You take your initial position on that move, which it gives it up pretty quickly, and then if you get this signal, you can come in and start to really get more aggressive with your position. So it doesn't mean it's going to work, but that's one way to work it. Also, not guaranteed that the market's going to blow apart here. It could fritter about for a few more days or even to the end of the year, because we're about take away all the holidays. How many more trading days we got left, Dr. K?
Well, in the year, we've got 10 because you got Christmas. So we got 10 trading days, and I think one of those is a half day.
Yeah, so we could continue to drift around into year end, and then we'll see what happens after the new year. But things aren't. It's very difficult on the long side as well, because I saw some of these breakouts on Monday, And you see this breaks out. It looks real nice. It's a pocket pivot volume signature type breakout. We didn't put a report out on it, mainly because we weren't so hot on these, although you could observe them occurring. And I guess if you wanted to, just like with any trade, you could have bought them on the basis that, you know, if it breaks below the pivot point or the buy point, you're just gone right away. But notice how it runs up a couple of days and comes right back in. I noticed Gilead had a move like that. You know, runs up again, and oh, look out! Now we're breaking down. And then this Poly one, which we thought was a decent pocket pivot the other day. Look at how quickly that just breaks down. So it's telling you, you know, you can observe these buy signals, and if you want to, if you feel that confident, you can go ahead and buy into them if you want. But you do have to have a quick out point, and I think what you're seeing here with a lot of these fizzled breakout attempts, it tells you that we're in a weak phase, and they're just sucking in buyers right now and possibly going to take it down. So, you know, just running through some of the stocks I'm looking at, Tiffany's I think is interesting. You had a breakout to the downside, you had this big gap up. You know, it might be shortable in rallies coming up into this area, say 59, maybe even today. They had been hitting retailers earlier in the week, and there were a number of them looking pretty bad. Coors was another one, you know, getting knocked around, retesting the prior low here and coming down towards the 200-day. But you can see that's been a weak area here recently. I've been keeping an eye on that. Alexion, I think, is interesting. You got this big left shoulder, big head. Now it's building these right shoulders. Kind of keeping an eye on this one. I've tried shorting it a couple of times in here. I haven't really made any money on it. It doesn't seem to want to give it up yet, but I'd keep an eye on this one because I think the pattern looks very interesting, and on a weekly chart you can definitely see it forming a head and shoulders, and it was a big leader, so it qualifies in that regard as a big massive leader that has now broken down, and now it's a matter of it forming these shoulders, and it could continue to form a number of right shoulders, so you keep an eye on that. I think Agrium is weak here. You have a late-stage failed breakout here. Here's the breakout up here, and it looks pretty good at the time, and it fails within a couple of weeks. You gap down on massive volume. Now you rally up into the 50-day, and now you're rolling over. It looks like you're headed for the 200-day. So, somebody calling me on my cell phone. People should know better, right, Dr. K? Doesn't that tick you off, people calling you up during the trading day? Don't they know we're busy?
Yeah, indeed.
Anyways, so I would say if you wanted to short this and let it rally, but I also noticed CF Industries, probably a short today. Look at this, is sort of a cup with handle type of breakout attempt. You already had a failure back up in here, and you rally back up, and now this thing is failing. You're rallying up into the 50-day. It becomes shortable here. Again, you just had an intraday sell signal, so that potentially is shortable here. Using, you could either use this as your stop real quick, or you could just use the 50-day at 208.25 as your stop if you wanted to. But I think that is potentially actionable this morning. It looks like all my quotes have gotten back in sync. So earlier this morning, I had my Dow quote was off by 8 points on another platform, our trading platform, and so I wasn't really sure what the Dow was doing. But I think this is a correct number now, so you can see we're sputtering out a little bit intraday. That's what the market looks like. Watch for a breakdown. That could confirm the short side. Let's see, Baidu is continuing to rally here, so it's not really breaking down. I think there's, is there some news out on Baidu, Dr. K? Did you see anything about them gaining share because of Google or something like that?
Let me check if there's anything new. I mean, it's...
All right, I'll run through some more of these. Here's Bed Bath & Beyond, big, ugly pattern. A couple of big gap downs in the pattern, and
nothing out there that I see.
Pardon me?
There's nothing out there that I see.
No, so I don't know. They're just pushing it up. I guess just a reaction rally. It did get a bit oversold, but I think the rally can become shortable, so keeping an eye on it here. Although somebody seems to like it in here, but you notice you get some selling up here, so we'll see how this pans out. I'm not going red on the Dow. Let's continue down my magic list of magic shorts. HLF, I think we talked about last week, and this looks shortable. It's breaking down, or it was back up in there. So, this one I think is interesting too, but it's kind of, it's a big. I don't know if you call this. This is your left shoulder. Here's a big ugly head, but it's rallied above the left shoulder. So I don't know if this is in play, but I'd keep an eye on this as some sort of a pod situation. They did have some positive news regarding a drug of theirs that they're developing with J&J. It looked good to me coming up into the 50-day, but that was a quick stop out if one was trying to short it there. I actually never really tried to short it, but I'd keep an eye on this. It is somewhat interesting, I think. You got F5. These are all breaking down in these big macro sort of rolling top patterns. You know, you can see this sort of big head and shoulders, and you got a bunch of shoulders, and now here you are running into resistance. This looks like it's having some problems. Let's see. Get this straightened out here. NSM I think is interesting because you're looking at a potential. Well, you have a failed base here after a big run, but it's starting to look a little bit like a head and shoulders type of thing. But you got a right shoulder's a little higher, but it's starting to break down. We actually looked at shorting this yesterday, and we should have done it yesterday actually, but we didn't. And it's breaking down. You're actually seeing volume, and I would keep an eye on this. I don't think at all that you're seeing a recovery in housing. I think that entire thing is a cover-up, essentially, where you have, look at Apple starting to break, where you have the banks not wanting to put properties out in the foreclosure market because that would drive prices down. And I would suggest checking out, there's a guy, Keith Giroux, J-U-R-O-W, who's a housing analyst for Minionville.com. I would suggest checking out his stuff there. He does his own original research, actually goes in and digs out numbers rather than just going with the consensus garbage that the government puts out, or this Case-Shiller index, which has a lot of embedded assumptions, and does some very original work, I think, and you should check that out. But his view of the housing market and what's going on underneath the cosmetic statistics put out by the housing industry and those who have a stake in seeing housing hold up, I think makes him very unique and insightful, so I would check that out. Again, his name is Keith Giroux, J-U-R-O-W, and he's at Minionville.com. Some of you may be familiar with that website. I know Dr. K's been interviewed there a couple of times when we've been in New York. You notice Cirrus is breaking down. That's just a nice ugly gap down. I think it just moves with Apple, and that's pretty much that story. Let's see, just popping through. LinkedIn was interesting. You know, it's gotten back above its 50-day moving average. You had a pocket pivot type move right here, I think it was. Yeah, just barely right here. And it's been able to wedge higher, but I don't think I'd be buying anything in this environment. CRM also, you had a breakout, and that's actually holding up tight, believe it or not. This is a stock that a lot of shorts have hated for a long time, and you know, they've had some brief flashing moments of success, but overall the stock has never really broken down. Oh, let's see, Intuitive Surgical, you had a pocket pivot type move here on Tuesday, and stock's pulling in, but you know, this, to me, I guess this stock is moving around because of the talk of the tax, I think, on medical devices that the Obama administration is proposing, or Congress is proposing. I mean, like Dr. K, in our report this morning, I liked his line that he stuck in there about the only mining that's going to go on is tax mining as the government scours around for new sources of revenue. So we write the morning piece together, just so you know, but we each add, you know, our own little tidbits and insights in there individually, but it is a joint effort, as is everything. So some people will email us and say, oh, Dr. K writes this, or Gil writes this, or no, we both write it. We pretty much, in our own twisted way, write everything that you see. So, right, Dr. K?
Exactly right.
All my builder friends are working like crazy, says somebody. I know, what are they building? I'm wondering, is it houses, or I notice apartments have been doing a lot better. So I talked about Baidu. Someone says, here's one for you, Dr. K. I understand the signal change in UVXY this AM since Apple and Google were hemorrhaging capital, but the signal changes in UVXY are more of a black box than the MDM. Can you offer us any more guidance on what is material?
Well, it's generally a shorter term strategy when it's on a buy signal, simply because the markets tend to drop a lot faster than they rise. So the the buy signals in the model are going to be on rarer occasions. The sell signals are going to be more frequent, and they're really designed to track upward trending markets. And it's really a matter of utilizing what these volatility indicators are telling me, and also in accordance with the VIX, although the VIX is not the premium component. And that's why when people say, well, the VIX doesn't correlate with these other instruments, and that's absolutely true, but it doesn't affect the model in any way. But it does. The model does bide its time when the VIX is behaving in a certain way. The model will account for that, and the model is more likely in such situations to issue more sell signals than buy signals.
Okay. Somebody says, "Are we still holding VRX?" I don't know. I don't know about the we. I'm not sure where that one comes into, because I'm not inclined to take any long positions. There was a pocket pivot here several days ago, a couple of weeks ago actually. And if you bought that, you're asking us, are we still holding it? So you're asking for a recommendation on what to do with the stock. And what I would say is we don't provide buy and sell recommendations per se. If you're looking for buy and sell recommendations, then that would be the market direction model. If you're that helpless, and if you do own VRX, then you really just have to assess the stock on, number one, your expectations for the trade, number two, the market conditions, and whether this breakout has a chance of working, number three, the position in its pattern. So as you're coming up to the top here, you're obviously going to run into resistance on the left side, and last but not least, whether the stock breaks whatever stop you, not we, have put on the position if you decided to go long in the pocket pivot. If you did, that was a smart trade because you're making money. So if you start to see the market weaken, then you better start thinking about whether that trade stock maybe needs more time to build a handle if it's really going to work, or whether you think you have a nice profit here and you'd rather have a bird in the hand is worth two in the bush, and so you may decide to take profits on that basis. But that's really got to be up to you. So, and the idea that we have to tell you what to do with this position if you bought the pocket pivot is really not the intent of the website. Let's see. Would the last blowout earnings in WFM defer you from shorting? Well, let's emphasize that when it comes to shorting, fundamentals have absolutely nothing to do with the situation, because usually the fundamentals look best at the top. Case in point, Apple. So, our view is that you short a stock on the basis of its technical pattern. And I think I'm going to bring up I should bring up a weekly chart here. Let me just tag a weekly chart. Whoops. Uh-oh. I think my e-signal is going to blow up on us here. Let's see. Sounds. No, I don't want that. I want... let's go there. Here we go. Beautiful. Go to a week. Whoops. Over here. Weekly chart. So let's look at... you can see how ugly Apple looks. Big head and shoulders. But let's look at WFM on a weekly chart. So you can see you have a left shoulder, a big head, and now you have this right shoulder, so it's starting to break down. So on that basis, you could consider it shortable. You'd want to use a 200-day as your maximum upside stop, okay? But, that pattern is in position. So you base it on the technicals, forget the fundamentals. Remember, while we buy on the basis of technicals and fundamentals, a techno-fundamental approach, as Nicholas Darvis termed it, we sell solely on technicals. Right, Dr. K?
This is correct.
So, and you're right there, Rex. It is a rounded top or head and shoulders stalling out at $100. Apple looks to be breaking the neckline of the H&S formation. Well, let's look at Apple here. The thing about necklines is they're kind of like, trend lines and stuff like that. You can draw them all over the place, and if you draw enough, the stock's always finding support or resistance at some point. But we would say a logical neckline would be here, so you're getting close to it. But I think you're going to go through this line, and you could just blow wide apart. Remember this phenomenon of trapped longs that I've been talking about in the stock, and that could drive a real panic low. And you don't have, whoops, let's see, get rid of that. You don't have much going on between here and here in terms of support. So this thing could go in free fall, and it could take you to 420 somewhere down there. That's a possibility. So, I think what you're doing today is just watching this. If you're running a very heavy position like I am, then you may, if you got a buy signal here with this line moving back above the blue line, the orange line moving back above the blue line, then what you would be doing is covering the heavy part of your position, or you could even cover all of it with the idea of coming back in if it rolls over again, if you want to play it real safe. But I think, a core position in Apple on the short side is probably going to continue to produce results. You better watch how it acts, though, as it breaks down. The potential is that it could break down below the neckline, and that could be seen as a breach of major support by the crowd, which could set up a short little bump to the upside. And a lot of times I like to take some profits if I'm running a huge position and back down either to a core position or to cash, and then come back after the stock on a brief rally once I get another signal using this chart. So, there's a lot of ways to skin a cat here. If you're running just a core position, you've just been staying short since we talked about it up here in our pre-market pulse a couple of weeks ago, I think 2 Mondays ago exactly, and that was a top. Then you're doing okay. You can just sit with it if you want to, and it may turn out to work out pretty well. So anyways, Chuck, the Apple breaking the neckline of the Head and Shoulders formation, not quite yet. If you wanted to draw it, from here to here, I guess you could say it is, but I would use the lows here. But again, it's not an exact science, so you're just kind of watching. I'm watching how it acts as it comes down below this low, which is 505.75, but it looks pretty grim. And I feel sorry for anybody who's dumb enough to buy Apple on the way down. So I talked about CRM. I don't think it's a short. Whether it's going to have a big upside move is another issue. eBay, you had a breakout from this little weird double bottom base. But notice how you move to a new high here. I think this is a little suspect, so I'm not really interested in owning eBay, and I'm not interested in owning any stocks right now. So those of you who are asking about the long side, don't expect me to reinforce any idea that you should be buying stocks, because I think a lot of these breakouts are just going to break down, and that's what you have here. You have a breakout, and now you're back just below the peak here, and I don't really care much for this. I think Expedia was also trying to show some strength the other day with this sort of not quite a pocket pivot move as it got up to the 10-day moving average, but not above it. It was 4 days ago, but it's starting to roll over too. And I think with Priceline coming in, a lot of these online retailers may have some issues. All these old big ones. Amazon could be a pod. I'd watch for that. It's breaking down below the 10-day. But it did have a nice bounce back reflex rally that saw some volume and some sustained movement. So, on the one hand, Amazon's got the PE of, 300 or something. Apple's got the PE of what? What is the PE now at, Dr. K?
No, I thought it was like let's see.
Right, it's 11 times estimates. So, Apple keeps going lower and Amazon rallies back up. So, we wrote an article that came out in MarketWatch. It actually came out a week late. They took their sweet time getting it out, but, I guess better late than never. But we pointed out, that if you're basing your analysis of Apple solely on PE, then you're just asking for trouble. So Apple suppliers are crashing on order cuts. That's true. Qualcomm getting hit.
Okay.
And look at that. And I showed you Cirrus Logic earlier. SWKS breaking down. So the whole thing is confirmed. And I guess you just go with Apple and short the crap out of Apple and enjoy the ride for as long as it lasts. Somebody says not in Los Angeles. I live here in the west side. Lots of private money hitting homes. Yeah, the rich people are still building their homes, but the rich people always have money to deal with, so it's not really an issue for them. Equix, this one had a pocket pivot. No, not Dequix. Whoops. Got a little bit. That's my 6th finger there doing that. And this had a pocket pivot coming up through here. Right here on the 50-day, and it's holding up. But again, it acts okay, but it's not a stock that we're not interested in being long here. A lot of remods, okay. Big homes with money. Not Pete, Keith with a K, Keith. Keith Giroux works for Minionville.com. Oh, I like this question. I asked Dr. K this question a lot, actually, and this subscriber says, I have a lot of respect for you guys. Okay, I like that. But what I don't understand is why are you guys messing with something as scammy as UVX, TVIX, almost scammed investors overnight? I would tend to agree, so that's my view. I wouldn't mess with it myself. But Dr. K, you can explain your position.
Yeah, the perception is if you hold these things, with the expectation that they're going to go up, it's a rigged game. And that's true because they generally have a bias to fall if you look at the charts of either of these instruments. And TVIX, of course, is going to be phased out. But as long as the liquidity of the price on UVXY, XIV, VXX, and these related instruments maintains itself, then as I've recorded through live trading, the slippage is almost zero. And the model, in other words, the results in the back tests correspond to the results in real time. And the slippage is actually remarkably low. I thought it would be higher based on time and price slippage, but they're virtually zero. I mean, we're talking 0.0005. I mean, less than one, half of 0.1% slippage, which is actually quite good. So, in other words, the results are playing out. So I'm not concerned about holding these instruments because that's not the nature of the model. The nature is, though, to catch an uptrend. And if you look at uptrends in the general market, they tend to persist. And if you correlate that with, say, VXX or UVXY, you'll see that they fall in a very pronounced way. So there's a lot of profit potential on the short side in these instruments. If you can't short them, and most brokerages will lend the shares, but if for some reason yours doesn't, either switch brokerages or you can always buy the XIV, which is the 1X. And again, I've looked at how the model handles VXX versus XIV versus UVXY, and the results are about what they should be in theory. Practice shows that theory is very close to the mark. So I'm very happy about that. Now, until I start to see some bifurcation or dislocation in these instruments, there's no reason to abandon them. And that applies to, by the way, any leveraged ETF, like the 2X and 3X type ETFs that exist out there. If you look at TZA and TZA, for instance, which is the 3X financials, and then you look at there's TZA and there's the other 3X, look at F. If you go to X, FAZ and FAS, that's it. So FAZ and FAX, you could say, well, these are rigged because look at how the price on both tends to go lower over time if you look at like the last year segment, but that doesn't mean they're not playable if you have the right kind of timing system with these. The key is not to, you're not going to be holding any of these instruments out to months because unless, again, you're shorting them, then it's a bit of a different story because these things tend to trend down towards zero, and then they have to do reverse splits on all these instruments to get them back to a normal price. So keep all that in mind.
Yeah, and my take on all this stuff is I don't think you need models to make money in the market. I think all you need is a few good stocks to play, and that's pretty much how I made my money in the market. So, why I think these things are interesting, my view is I don't think you need to mess with them. And if they give you trouble, what's that?
But 620, for instance, is a model, and that
it's more of a short-term trading system. It's not a model. It's been back
since 900 years. It's purely semantics because obviously every trading strategy I've ever done is a strategy. It's not a model because there is no black box.
You can apply this to any stock and any security for the most part. Whereas if you're trading a model that's strictly dealing with the UVXY or the TVIX, I think that's a little bit more difficult than applying something that is actually being shown to work in the market versus, to say, the market direction model.
I think it comes down to risk-reward. I mean, if you have a system that's proving out risk-reward, then it's going to be superior if it has more reward, less risk than, say, a system that works across a basket of stocks but has inferior risk-reward. As long as that risk reward continues, then the model, it's semantics, model, strategy, call it what you will, is still in play. And I mean, you know, the O'Neill system, of course, is, you know, works across only specific types of stocks, the CanSlim, you know, higher quality ones, and it's viable. But the risk, of course, on that kind of system is quite high, and it always has been, even in the 90s, which explains why, you know, we can have some of the best guys out there can have, you know, 50% drawdowns when the market's not right, such as in second and third quarter of '99.
Right, and guys who are following, using their models that have worked for, you know, during prior cycles, but don't seem to be getting any traction in this market. So, you know, my view is these VIX ETFs are all just junky stuff, and I just avoid them. That's my view. So you can believe Dr. K and go ahead and play them, or you can just avoid them like I do. So, you know, I think that's what it boils down to.
It's all about risk reward. I mean, it's not about getting biased towards something that the media says is ill-gotten. It's really about risk reward on these things. And so far, 620 risk reward in the crossbow, and, you know, utilizing it across 3x ETFs or, you know, these volatility instruments. Again, there's the risk reward is very pronounced.
To me, all just statistical constructs. They sound good, but do they really produce any real results?
Well, in real time since July, so that's about 6 months. And again, it's not 60 years, but, you know, being reasonable. I mean,
but I also think another flaw in the models and is the fact that the assumption is made that if you're investing according to one of these models and you drop 30 or 40%, that you're going to get all of the bounce back that the model shows based on the back test, based on the assumption that you're going to be in there full boat, just like you were the first time. And I would argue that the risk-reward scenario becomes wildly skewed once you're down 30 or 40% and trying to use a model that keeps misfiring. So I think there are a lot of embedded assumptions about these models and how they perform that can't work through
O'Neill. The O'Neill system, of course, is very, very endemic to that, because you get these big drawdowns, and that is destabilizing. In October of 1998, you had a lot of people, you know, shorting that market when it was bouncing, and because they were destabilized from having lost so much money prior. So any kind of model, you know, system, strategy, call it what you will, is suspect to that sort of issue, you know, psychological destabilization.
Right, but I would tend to agree with this one person's comment that the UVXY model seems to be more of a black box, and I think that may be where there's an issue, because the O'Neill system is not a black box.
But it's no more black box than the 620.
But that's also not a black box, because you're basically using it to handle stocks on a short-term basis where you are seeing macro patterns that are breaking down. So, for example, it's simply used to handle a big position in Apple on the way down, but it is based, the whole strategy is founded, or the foundation for it is the macro pattern in Apple. So in that sense, it is not a sort of operate in a black box operating.
I see the disconnect. Let me give you a little bit more color then. The UVXY is obviously connected to market direction. That's why it can correlate with the MDM, and that market direction is determined, of course, by the major indices and leading stocks. So Apple obviously figures into the UVXY model. Yeah, I mean, if there's obviously a direct connection. If it were just purely based on volatility indicators and nothing more, then it would be black box, and it would still have its, you know, the risk reward that it does. Right. But then it would be a little bit more suspect, and I would agree with that. But no, it is definitely connected with the MDM, which is why you will see sometimes both of these models will switch signals at the same time, but not always, because again the UVXY is looking for shorter term plays in some cases. So even if the MDM might be sitting on a sell signal and the UVXY is on a buy signal, it might reverse out and go to cash. The UVXY might reverse and go to cash and take its gains because when the market refluxes and, you know, say has a bounce, UVXY is better off being in cash. Meanwhile, the MDM can stomach those kinds of bounces because that's what it's designed to do. It's designed to catch more of the intermediate term trends, whereas the UVXY is designed to catch not just intermediate, but also the very shorter term stuff.
Okay, I think we fleshed that one out well enough. But you know, that gives you guys a little insight into how we will debate things constantly about the market. I think that's also always very helpful. Anyway, someone asked about UNG. Commodities have been getting hosed, and I would not be buying this, and so I would not be shorting either. I just think it's in its own little world. Natural gas prices. The U.S. isn't allowed to export natural gas. I think that has an effect on prices. So you have an expanded supply in the U.S. Prices tend to be low. That's all I know about natural gas. Other than that, here's a pattern. It's breaking the 200-day, but I'm not going to short it or anything. Somebody asked about fossil. And fossil, might be shortable as it rallies in here, but you would want to use the 200-day as your cover point. Let's take a look at where did my weekly chart? I lost my weekly chart. Here he is. You can see this big pattern is big. I don't know. This is a big pod type formation. Now you're underneath the 200-day. So yeah, it could be shorted in here. And you'd want to use maybe the high today or 2 or 3, or as much as a 5% upside stop if you can handle that kind of risk.
Somebody asked we had a question, real quick question here about actually the UVXY. It says, I like the idea of this model, but I'm concerned about the lag time between the signals and the time the email alerts reach me. Since the UVXY is a volatile instrument, this could potentially lead to a substantial difference in performance between the results the model achieves and the results I achieve. Yeah, essentially, time slippage, as I found, time slippage should be minimal as long as you act on the signal when you receive the email. Since the instrument is volatile, on a minute-to-minute basis, you could end up getting a more favorable or less favorable price, but the differences should wash out over time since predictability of something like UVXY on a very short time frame, and we're talking minutes, is very, very small. So it's almost like random at that point. So I wouldn't worry too much about about that time delay, but do act on the email immediately, because if you were to wait a few minutes and the market if the market has a reaction to the upside or downside, that's naturally going to affect UVI in a fairly substantial way.
More questions. Somebody says, with everything rolling over, looking at Abercrombie and Fitch, someone's asking about that. Is this a short? It's not really breaking down, so I'd go after other breaking down. But why are the financials holding up? Somebody's asking. Well, I think because they're Fed favored, and all this liquidity going in keeps these guys afloat. So you've got Citigroup acting okay. Wells Fargo, though, is still a dog. Goldman Sachs, which I think has failed on a recent breakout attempt, could be shortable in here using the 50-day as a moving average. JP Morgan is also holding up. I think that's really the reason. The perception is that QE helps these too big to fail banks, which are really just on corporate welfare and in bed with the government. That's basically what's going on. So I think they're all slimy, and they're all in bed with the government, and they are part of what I would call the financial industrial complex, where these large Wall Street companies are in bed with the federal government, and the two of them are working hand in hand to cover up and paper over the financial crisis. So that's why I think they're holding up. Somebody says, "I love it when you guys fight." Oh, that was nothing. They should really hear us when we're fighting. You get a beep 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 beep. It's like, oh, we really go at it. But I would just say, from my own experience, I never made money using any of these models, and in the 90s I made my fortune owning stocks, and even today that's kind of what I focus on. I think the next market direction model signal that's going to make a lot of money is going to be a sell signal. That's what I think, and I think the buy signals are a little bit suspect because the market seems to move just enough to trigger them, and that's just my basic take on it. But you guys asked, and so we gave it to you. In my view, someone says calculating a position on risk reward is worthless. I almost said that. Foresight on where a stock will go is not as insightful as the risk. I agree, and I think that's really...
No. When I say risk reward, I'm talking about purely the absolute results. In other words, what's your drawdown? What's your annualized gain? What's your monthly gain? Purely on that basis. Right. We're not predicting anything using risk reward. It's one of the most basic metrics that everyone should know what their risk reward is of their portfolio, of the strategy they're thinking to use. And I guess the word model is a misnomer because it just connotes too much black box, and we don't do black box. I mean, everything we do is organic, and it's designed to be flexible with changing market environments. So I think we should just scratch the word model from the vocabulary, because then it also lumps it in with all these black box models that exist that come and go, because black box doesn't work. Black box has a limited lifespan.
I think we should just call them thingies. So we'll call it the market direction thingy. How's that? Rather concentrating on how much you are risking is more plausible than, I guess this person says here, foresight on where a stock will go is not as insightful as the risk. Rather concentrating on how much you are risking is more plausible. Well, I tend to look at any trade as I'm willing to lose this much on the trade, and that's it. And that's kind of how I handle it. So,
yeah, always know your risk, but as far as your reward, you don't really. I never know my reward. I just can say, well, this stock is very favorable on the long side or the short side. I don't know how far it's going to go, but yeah, you always have to have, with every position you ever initiate, always know your exit point. That's a cardinal rule.
Oh, I love some of the comments we're getting. Girls, please, they say, get back to looking at charts. Are you implying? Are you? That sounds like a sexist comment that only women are allowed to argue. So I don't know. At least we're not going rear. We save that for when we're in private. But somebody's asking about gold and silver, and silver was looking like a pocket pivot, and that's instantly negated. So we put out that pocket pivot alert after the close on Wednesday, and hopefully people figured out by yesterday that that was really not action because that's failing. And I think there's a problem in QE land here with the way gold and silver are acting. You would think that with the Fed announcing essentially that they're going to be pumping QE into the markets until 2015, which is when they see employment finally getting to that level that they're talking about, 6.5%. But remember the Fed, how great are their forecasts anyways? They're generally junk anyways, so I wouldn't pay any attention to that. But I think it's interesting that when they do announce this sort of QE to infinity and beyond, commodities, and you saw it in, crude oil also came off, but you're seeing natural gas. I think copper also got hit, and I'm trying to remember what the copper HG. Here's the.
Yeah, and the commodity.
Well, it's down yesterday, so.
Commodity Research Bureau Index, the CRB. If you look at a weekly chart, that has generally been in a downtrend since the middle of last year. So yeah. There's something wrong. I mean, all this QE is not helping to shape up hard asset prices.
Yeah, I mean, we don't argue about that one. There's something is disconnecting here, and that's what's troublesome, I think. You're seeing the market keeps coming off here. How similar is your trading style now versus when you ran money for O'Neill? Well, I think the 90s were more of a trending market, and I think I've corrected my trading to do less of this aggressive, get big, and try and sit there and ride a big trend and trade more around the edges. Because of the inherent volatility of that QE, I think, injects into the market. So that's how my trading style has changed a little bit. That's
all that. I mean, buying within the base, buying early, not buying the base breakouts, not buying the stuff that seems so obvious, because obvious doesn't seem to work in this decade, whereas it worked quite well in the 90s and the 80s. And then therefore, position sizing is smaller in my case. Although I will pyramid something if it's working, but not a whole lot's been working the last 2 years. So it's this environment. Well, the last 2 years has probably been the toughest environment I've seen since I've been doing this 1990. And I still remember O'Neill's comment was 2009 was the toughest year, but I think he would restate that to say the last 2 years have been a lot tougher than 2009.
Yeah. Someone's asking about Lulu. Oh, by the way, somebody's asking, is this a 5-minute chart? This is somebody obviously who's new to the webinars because we've been talking about this chart for a long time. It's a 5-minute chart and it essentially uses a orange 6-period exponential moving average and a blue 20-period exponential moving average. And what we do is just kind of use it as a guide for coming after stocks when you see a breakdown with the orange line. And you have a MACD with the same settings, 62010C. When you have them coincide together, that's a sell signal. You notice you're getting a turn here on the MACD, but the stock isn't confirming that. So that seems to tell me if you had another breakdown in the MACD, you might see another leg down, and you could come after it again on that basis. But that's what this is, and it's just a short-term trading system that I've been using to help me get into stocks every day because I don't want to carry heavy positions overnight given the nature of the market to gap up and down. So Lulu, pocket pivot type reversal here. Big funky move, but it's very V-shaped, so skeptical of this. It's moving higher. I think you have a lot of shorts still in the stock who are gluttons for punishment, but I think I would not be buying this as any other stock. Dr. K, you have opined that all of the Fed's money printing may provide the catalyst for silver taking off on a long sustained uptrend, but since this money printing is already widely known and has been discussed by pundits for many months, why hasn't this rally already occurred? Could it be that big investors are just unwilling to invest heavily in this choppy market in anything, including the precious metals, and the silver move won't happen until the market's volatility abates? I'll give you my take. I think if stocks get into trouble, SLV and GLD, it's just all paper gold and paper silver, and all paper assets get sold off together. Dr. K, your take?
Yeah, I mean that's the first point, and then also we really got the fiscal cliff to deal with, and we're just days away from that. So I don't think there's a whole lot of institutions who want to step up and start buying en masse any sort of hard assets, because everything will get taken down. Stocks and hard assets, everything will go, just like we saw in 2008 when the market crashed. And gold and silver were not immune, certainly, to that drop.
Somebody asked me, when shorting Apple, are there follow-on buy points on the way down that are more favorable? I don't see any buy points in the stock. Do you mean short sale points? Is that what you're talking about? I think just hitting points, here and on these rallies and where you see resistance and coming after it and shorting it on the bounces and adding to a position if you're playing it that way. So, that's really all I could say, is that there are add points on the bounces that are low risk. Like you see it break the 200-day here, and then you see a little bounce back into the 200-day. You could short there. That would be a spot to come in after it. And that might coincide with my little 620 model thingy. Or, no, wait, my 620 thingy, we're going to call it.
Yeah. No models.
Because just look at, say, 3 days ago.
It's a strategy. It's a strategy.
It's a strategy, right. And it's just
every strategy's got a risk-reward associated with it. And then you can decide, how much risk, how much you want to put on based on that risk-reward characteristic.
Yeah, and again, I think any calculated risk-reward scenarios is hypothetical. I mean, it is theoretical.
Of course. No, you got to measure. What's interesting is to measure your risk-reward as and compare the real-time trading to the model and see how close it is. And if it's what I've found is like with 620 and with Crossbow, these are short-term systems, but the risk-reward tends to remain roughly in real time what it was in the backtests, which is again, and the slippage is really minimal. So that's all bodes very well for these models strategies continuing on.
Thingies, we're calling them. Anyway, somebody's asking, on this question about Apple. If you look back, let's look at 4 days ago. I thought it was shortable here because you were showing some resistance on an intraday basis over the past few days prior to that, and it seemed to get weak around that 550 area with maybe a peak somewhere in the the 550, 560 zone. So what we noticed is 3 days ago you were up at around 550, and we got this signal where the orange line drops below and it coincides with the MACD, and that's a short sale signal, and it actually holds all day. You do get this buy signal here, but a lot of times if I come in and enter a core position, if I don't get pushed back up to where I came in, I'll just stay with it. And then you can see the next day we had the same thing happen as it broke down here to here and moved lower, and then yesterday the same thing happened again, and now this morning we're seeing it breaking down even more so pre-open, and so that helps me to get in at the right spots. Doesn't mean you're going to make money, but that's how I work it. You can work it there are other ways to skin a cat. So how close is the MDM to a sell signal? It's about 2 centimeters about right now, right?
Nanometers. No, it's certainly, if the market were to start, the selling pressure were to pick up, it's not far from a sell signal. It's closer to a sell signal than a buy signal, given where we're at right now at this very instant.
Yeah. Somebody's saying that HTZ is a sleeper, good time to get in. It's a $16 junky stock as far as I'm concerned. 24% earnings growth. It's to me there's nothing dynamic here, and I don't see this as something I need to get into right now. That's my view. EMN, Eastman Chemical, I've seen this one. It has great fundamentals. It's moving higher. I don't know why, but yeah, it's edging higher, but I'm not a buyer. So Sound like Johnny Cochran there. Edging higher, but I'm not a buyer, and that's the end of that story. You got any strong thoughts about that stock, Dr. K, or Hertz?
Put me to sleep. You know, this EMN.
All right.
You know, really.
Say no more.
I've never made big money off any kinds of stocks like this. You know, it's like playing IBM.
Hertz, even worse. You know, it's very consumer oriented. Not sure why it's moving up. You know, I don't know, but it's not something I think has a lot of upside potential. Somebody says UFNN, European financials are doing well. Yep. Policies favor those financials, I think. You know, these money printing policies.
Now we have the question, why is it that volume information seems to lag price information? The action in SLV on December 12th is a good example. I used MarketSmith to track volume. By the end of the day, it looked like volume would not be enough for a pocket pivot, but later the volume was adjusted in the criteria.
After hours, that's right.
Yeah, volume. Hours. Right. Volume should not lag price information, though. In some cases, where the volume tabulations are delayed, there could be a discrepancy. I'm not familiar with the accuracy of MarketSmith. We use eSignal, and that does seem fairly accurate, but in a rare occasion, you might have tabulations which come after the close. So just be aware of that. I mean, in our case, with SLV, we did not get any delay. We were using eSignal, and there was no the volume information did not at all lag the price information. So I think that's a condition of MarketSmith.
Yeah, that's actually a condition of all O'Neill products, even Wanda. So. KRE, Spider, S&P Regional Banking ETF, shorted. I'm not going to short it. I don't see any shortable pattern. I don't really understand shorting ETFs, so I don't really do it. Price lines volume was just average as it broke down below the 50-day. I don't know. It broke down and the volume picked up, so it doesn't necessarily have to be heavy volume. And the fact that it couldn't sustain a rally earlier in the day and it comes off, I think, tells you everything you need to know. So any rally up into the 50-day, even up here, which is only less than 1% away to the 50-day moving average, to me is shortable. I don't really use that as a factor. If I see the volume picking up relative to weaker upside volume on a bounce attempt 3 days ago, then to me that's a sign of weakness, and I'm just more than happy to short the stock at that point even. Here's a good one. You all should fight more. Seriously, it will help point out to people that they can do whatever they want. I think you can trade anything, and there's a lot of different ways to skin a cat as long as you know where your stops are. This person says, I generally wish that Dr. K would talk more.
Wow, that's a first.
I wish you would too, but you don't really like to talk that much.
Usually people are telling me to shut up.
Yeah, so I don't know. That's I don't know. Have some kids, and they never want to listen to you talk. Anyways, how much do you think electronic trading has changed the markets? I don't know. I don't really pay attention to that. Do you have any advice for people with smaller accounts? Not really. I started with $3,000 in 1991, and it built up over time. So you don't.
That's really nice. The commissions are so low now compared to where they were in the 90s.
Yeah. So I think
you can have a tiny little account. You could have a few thousand, and it's perfectly viable for trading the markets because commissions are going to represent such a small percentage of your account value.
Right. I think that's an advantage for smaller accounts these days relative to back when Dr. K and I had smaller accounts. Somebody says central bank isn't buying gold or buying bonds. Yeah, really. Do you buy into the conspiracy theory related to capping gold and silver prices? I'm not sure what buying into that means. I'm not going to buy gold and silver if they're not going up. If I think there's a conspiracy holding them down, I'm just going to watch the price action. But yeah, that's a possibility. Slop and chop. I haven't heard you all use that term recently. I don't really see the market as all that slop and chop if you're going after the right stuff. I think Apple has been a beautiful short sale target, one of the best ones I've seen in a long time, and it's still working. So that doesn't look like slop and chop to me. This looks like somebody shot it in midair and it's just fluttering to the ground. Have either of you seen any relevance using a 5-day exponential moving averages? I mean, if you're short-term trading, maybe you can use it. I think I know a guy who actually does use it. Car. What is car? I'm not, the $19 stocks, I'm just not into it. I don't see anything here that I need to get involved with. Is there a list of historical IBD follow-through days online somewhere? I don't know. Ask IBD. Why do we always get hit with these questions about IBD? Why? Why? I mean, we don't work there, and we don't even talk to anybody there. NSM is close to issuing another sell signal. Yep, I think that looks pretty weak. Does O'Neill still hire traders? I know he's been firing a lot lately. A couple people I know who were running money for him got fired. So. Visa. This is the last question because it's now 9:06, so we've gone over an hour. Visa, what is your opinion? Uh-oh. Boy, my whole e-signal decided to die on me there. Cheap Windows programs. I hate Windows. I don't know. It's not. There's no breakdown yet or sell signal, so I wouldn't do anything with it. I don't really have an opinion on it. That's pretty much it. So I hope I gave you guys some insight into what's going on the short side, the way we've been working it, and it's actually produced some results. Whereas trying to go long anything really hasn't. So that's kind of where we stand right now. So hopefully it was helpful and you get a little idea of how Dr. K and I like to catfight over models. But I guess I don't have a big background in statistics, so I don't give them as much credence, I suppose. For me, it's just harder to grasp onto, and my way of looking at the market works better for me. So that's just that story. Anyways, any last comments, Dr. K?
Yeah, it goes to show that everyone's got to find their own path. Just like with everything, whether you're even if you're composing music, some people don't even. I don't use standard notation. I created my own path because it worked better for me. I found it more efficient. Maybe it just works better with my brain. But with this trading strategy, you got to find your path, find what works for your risk tolerance levels, your trading style, your trading personality. Some people like to buy on weakness, some people like to buy on strength, and it's a very introspective journey that every investor has to take, and it's a long process. So what we do is this is a labor of love, and I think that anyone who reaches success in the markets on a somewhat continuous basis, over the market cycles, would agree that it's an absolute labor of love. It's not easy. There's no such thing as get rich quick or no such thing. So you ultimately have to stay the course, stay in focus, and if this is something you're passionate about, then the odds are that you'll figure out a way eventually.
All right, that's it for me. We're out of here. We'll catch you guys next time.
So long, everyone.